So let's bring our friend Todd Halterman back to the conversation this morning. Tax season, Todd. It's I just saw tax season is up and running. We can start getting our W-2s are out. A lot of companies are just do it electronically, so it doesn't take a whole lot of time. It's not like it used to be. But what do we have to expect this year? I just saw that in Orange County, California, we get an extra month to fill out our taxes or file our taxes this year. Is that all over the country?
The extension for tax filings.
Yeah, we got an extension here. I don't know if you saw that because you're in Idaho, but the because of a natural disaster, Orange County, California is part of a natural disaster. I think it's just the natural disaster I see is Sacramento, but that's a whole different story. Right? But we get an extra month to file taxes out here because of the natural disaster.
Yeah, no, I don't think that's nationwide. I haven't gotten any word of that up here in Washington and Idaho, but I'll have to look into that.
So what are the highlights that you're seeing? I know, and this is one thing that I talk about all the time is that, any of us, anybody, I guess, around the country, you probably are not up to the latest, maybe you are, but the latest code in plumbing and electrical and construction because you're busy working in financial planning, just like the construction worker probably isn't up to the latest of what's going on. You have to go and get that continuing education. I know you spent a week's tough life in Arizona, getting educated. So what's our takeaway?
Takeaway is right now that the American attitude is almost a self-fulfilling prophecy of recession. Never before has our economy seen a recessive environment coming on where everywhere you look, there's help wanted signs. Manufacturing seems to be getting caught up on its backlog, albeit not quite yet. The China shutdown has affected a lot of distribution and lag time. That should be correcting itself further into the year. Corporate America is flush with cash. I mean, we've got a lot of broken stocks out there, Ron, but we have a lot of profitable companies and companies that aren't broken. And the outlook is make sure you're in companies that have strong profits, that aren't high growth oriented because they're most volatile in these type of environments. And we're looking for long-term expansion second half of the year. But it could be a little slower than we expect because of the doom and gloom of recessive belief. But corporate America is flush with cash, Ron, and buying profitable companies whose stocks are broken like Microsoft and Google. There are a lot of companies out there with high profits. Their stocks are down 20, 30, 40%. And frankly, from a long-term perspective, way overcorrected and a great value to buy.
Can you help me understand what do you mean by a broken stock? I mean, you say Microsoft is broken. What does that mean?
Well, if you're a company that put out toys that had lead paint in it, that's a business risk. That business risk will affect the company's stock when they have to recall all those toys and lose profits. That's a business risk. Market risk says in a rising interest rate environment, in a rising inflationary environment, with companies that want to grow, and it's hard to grow in these types of environments, their stocks get hit extraordinarily hard because that industry or that marketplace, the technology sector, the banking sector, some of these sectors affect the stock pricing, so it breaks the stock price, but it hasn't changed the profitability of the underlying company. An example is in 2008, Hugh Hefner got on TV and being interviewed by Matt Lauer on Today, and he says, "Hugh, do you have any regrets?" And Hugh said, "Yes, I have one." And Matt Lauer laughed and said, "What's that?" He said, "Well, I wouldn't have taken Playboy stock public because my company is worth way more money than the price of that stock reflects today." So if Americans were listening at that point, they should have loaded up on a broken stock, but not a company who's not profitable. So you can have a broken stock and have it be down, but that company, underlying asset values and profits, can still be strong.
So should I be looking at the dividends for companies like that, being that you said companies have a lot of, they're flush and their prices are down? Is dividends a good way of identifying some of that?
Dividends can be a good way of identifying who's putting out profits. Companies like Chevron and McDonald's and KeyBank. You could also be looking for earnings per share. There's a thing called EPS. That just goes to show you at the current price of a stock, how much is it earning per the stock price. So if you have a stock at $20 a share and it's got a $2 earnings per share, that just tells you something, that it has strong earnings and profits based on its stock price. That's a profitable company.
So for years, we were looking at watching companies that, they're making no money and the stock prices are going crazy. So is that the companies we should be staying away from now?
Yeah, companies like Tesla historically have had huge negative earnings per share, and due to pop culture and social trends and the hope and desire that market in electronic vehicles, Tesla will continue to dominate. Well, today, if you look at their corrected stock price, their earnings per share is now positive. So their stock is fairly valued. But yeah, there's companies out there like Shopify and all kinds of tech companies right now who have huge negative earnings per share, but their anticipated market share and growth outlook can be huge. But right now, it's a good time to hide in dividend-paying companies who have huge amounts of cash on their balance sheet, who have a long history of profits. Coca-Cola's had profits every year for almost 30 years. I think Dow Chemical is 59 straight years of profits, growing profits. These are organizations that have weathered many recessive environments, and they put out profits and people can hide there.
Sounds a little bit like Berkshire Hathaway's portfolio, but I'm not going to go there, right? I mean, the guy's done pretty well for year after year after year. And being that I'm still one course away from getting an economics degree, but I've been one course away for almost 40 years. Don't think it's going to change. I can say this. Todd, they probably didn't tell you this at the conference that you were at. Economists have predicted 11 out of the last 4 recessions. Just throwing that out there. So if you just a little humor there. Todd Halterman is with us. He is our favorite financial planner, not giving specific advice, but he is giving us education. If you want specific advice, that's what he does for a living. That's how he supports his family. So give me a call at 800-306-1990. Happy to put you in touch with our friend Todd Halterman. So Todd, one of the questions I want to throw at you, and it's something that I learned back in my days at Merrill Lynch a long time ago. So I was there just during the .com time frame. And one of the things that we talked about was when everybody is talking about the stock market and how great the stock market is, and that's the conversation around the water cooler, probably a good time to sell and get out, right? Because everyone's talking about it. They're so excited about it. They're mistaking. I'm going to date myself. We used to have to go to in the newspaper, they had these pages that were the stock where you could find prices of stocks because they weren't so readily available. And we used to say, well, you put the newspaper up on the wall, throw a dart, and you can find a winning stock. Not quite the same way today. But my question, Todd, is if everybody's expecting this recession, am I so far off to say, something, maybe we're not going to get a recession because everyone's expecting it? What do you think?
Yeah, the numbers are really funny right now as far as profits and earnings. Wall Street's gotten very greedy. So the markets have been overreacting to what I'll say neutral news. A company that isn't growing 20 and 30% year over year in profits or in distribution is now seeing a lot of negative impact of their stock price, but they're still profitable and still growing. So there's just a lot of greed in Wall Street really built up because the expectations changed from 19, 20, and 21. I mean, growth investors were up 60% over that 3-year period. So the 20% pullback, they've kind of forgotten that they went up 60% over 3 years, and they're just focusing on, oh, I gave back some profits. This is a time to understand long-term financial planning and put the down market to your benefit to work for you instead of fearing it. So the recession, I don't know. The answer is neither do economists. They're all guesstimating, but corporate cash is high. Company opportunities are there. Depending on where you invest in the market, you could be seeing profits. Like In the last year, aerospace and defense is up double digits.
So you may not be familiar with Doty's law of economics. So Jim Doty, former president emeritus at Chapman University, and they're usually one of the top, in the top 3 of all economic forecasts nationwide. Even though it's a small little school, they generally outperform Goldman Sachs and J.P. Morgan and in their forecasting. And Doty's law says that whenever an economist tells you that they've got a 40% certainty that we're heading into a recession, what that means is they don't know what the hell they're talking about. So I just throw that out there for you. But what I'd like you to chat about, Todd, is, and I don't want to get specific on anything, but you may need to use a stock just for an example. But, you're talking about these companies that they come out and they report good earnings. That's, I think, what we want companies to do.
Sure.
But they're not in the 20 and 30% range. Maybe they're only at a 5 or 10%, which is still great. And the stock price gets hammered. Or a company like Goldman Sachs today, their stock is down dramatically. I don't think that the company is a bad company. I think it's probably a company that most people would want to invest in, and they've had a pretty good track record historically. But, they're down 7.5% today. The question I would have is, number one, what are your thoughts on buying dips? And number two, if you like buying dips, do I go all in, or can you explain what dollar cost averaging is?
Yeah, well, successful investors are patient and they buy on dips, but it goes back to, why are they buying in the first place? The market buys up 6 months in advance. So are you buying it because it feels good, or are you buying it because it looks to be a profitable company with growing distribution, growing balance sheet, and growing profits? If those answers are yes, then you should be looking at them. When organizations like Tesla fall significantly and now they're profitable in their earnings per share and they lead their industry and sector in what I would say opportunities, it's hard not to buy a Tesla or a Microsoft, who really truly have a competitive advantage over most of their peers in that industry. So, and I don't generally go all in on a stock because you just can't guess this market, especially this first quarter. But dollar cost averaging is what a lot of people do in their 401k. Each and every paycheck, they take a little bit and they buy into the market on a regular interval. So they're catching the down market purchases, and as it goes up, they're buying shares, and that averages out to a better buy price. So a lot of times in this environment, over the next 4 to 6 months, we'll invest $100,000 in somebody's portfolio, $15,000 to $25,000 at a time, depending on what kind of sector we're in and what the volatility looks like.
So the great information right there is to don't put all your money on red, right? That's basically, so you're saying, okay, something, we're going to do this over time. Now, Todd, you're not when you're talking about financial planning, you're not really talking about that guy that's out there buying Bed Bath & Beyond right now, trying to catch it on the right upswing before they file bankruptcy. You're talking about really good companies, right?
Those are people that take more risk than they get in returns, and those are trading and execution, offensive moves, if you will. Planning is simply this. We plan for profits. We plan for volatility. We plan for opportunity. And if you were a client of ours this time last year, we were loading you up on energy and aerospace and defense and industrial properties and multifamily opportunities, and then tax mitigation. So all of those things were things we adjusted to, and our clients are experiencing some significant growth from that and defending some of their poor positions like Microsoft and Disney, who have been mainstays for many people and way down right now.
So you mentioned, Disney and Microsoft and those mainstays. I'm going to throw a curveball at you when we come back. Continue our conversation with Todd Halterman. So before the break, Todd was mentioning these mainstays that are out there. And I think what you mean by mainstays, just for the simple guy like me, is these are companies that have been around a long time. They're going to be around a long time. It's kind of like set it and forget it. They're good for your retirement. So, and again, part of one of the issues that you've got going on is you got to be careful even of the mainstays. So mainstays sometimes take a turn. So Todd was talking before about companies that are in their, their number one or number two in their business, in their sector or their marketplace. And I would say arguably one of the greatest CEOs of all time was probably Jack Welch. And he was a CEO when GE was flying high. And GE was, people think General Electric. But General Electric was a massive conglomerate of a lot of companies. And if you go and read Jack Welch's book, his whole thesis was the company is either the number one or number two company in its industry, or they're going to get out of that portfolio. That's not going to be a company that they hold. So, Todd, one of the things that I wanted to ask you about, when we know that, Disney's been a great company for years and years. Microsoft has been a great company for years and years. But what are your thoughts? I mean, GE was a great company for decades. And right now, I don't even know if it's trading anymore. How do you manage that part?
Well, and again, diversification is key to success. You don't put too many eggs in one basket is the old adage. But when we use mainstays, it's because they've got a long track record of and consistent history of profits, huge piles of cash on their balance sheet, and they have a compelling, distinct advantage against their peers in their industry. Doesn't mean that they can't fall and have a bad quarter or a bad year. An example of Disney is parks were shut down for a year and a half, and their media division stumbled a little bit in growth because of all the competition during the environment of lockdown and companies like Netflix that have taken on market share. So again, speculation and greed, but that allows Disney to challenge themselves to retool, get more efficient, and focus on the divisions where they're leading the charge. And Disney is a media giant, and Disney is an entertainment recreational giant, and they're leaders in the business consulting world. So focusing on those strengths will bring Disney back to the empire that it's always been, with competition, mind you. So you just need to understand the company and the why.
And therein lies the exact reason why you need to have a great financial guide on your team, right? Because you understand when you talk to somebody like Todd, Disney's, I love the company. My son works there, love the company. They've been great to our family. But if you look at what's been going on at Disney lately, their stock has sucked. Just calling it like it is, right? But when you listen, then you get the guidance from a professional who does this all the time for a living, not, somebody that's talking on radio or, I could tell you a lot about mortgages and a product that's got a 4% EPR right now. But the bottom line is you need somebody that really knows this stuff and studies it to be your financial guide. And if you don't have that, give me a call at 800-306-1990. I am not that person, but I can put you in touch with Todd Halterman. But Todd, as we go into a recession and, some of these companies, especially if you've got to be perfect or beyond perfect for your stock not to falter, what is out there right now that I can do for protecting the assets so I don't have to, so I can sleep at night? Are there products that you have out there that you know about that we can do these things with?
Well, buying the S&P 500 index right now is one of those buy entries where you're not sure of the real risk short term. Long term, we expect growth, but short term, how much are you willing to go down before it comes back up? So we, over the last 9 months, have been helping investors capture some of their profits or protect them. Ron, I don't know if you know this or not, but there are certain S&P 500 trusts that you can invest in that if the market goes down 10, 20, 30%, you actually get your principal back. These instruments are liquid. These instruments are held in a trust account through our organization or any other good, strong financial advisor. So these trust assets in the index can have principal protection. Some tools that we use, Ron, if an account is down 8%, their principal's protected, and that company will actually credit in the S&P 500 index 8% positive interest to their account. So a dual direction strategy is fun for us right now because if an investor wants 10% protection of principal on the down, that means they won't lose any principal, 10% or less. They can also get their principal protected, but a positive interest given to their account. So I'll give you an example. $100,000 S&P 500 index trust would go down 8%. Your neighbor's at 92%. Your account would be at 108,000. So instead of being at 92,000 like your neighbor, the dual direction option allows somebody to be up 8% while their neighbor's down 8%. And in this environment, we have a lot of people asking for dual direction protection.
So I'm going to really hit you with a tough question right now, but you're a numbers guy and I'm going to put you on the spot. So think about this concept. So if your account is down 8% and you're using small numbers, so it makes it harder for me because I can't do it in my head that way. But if your account is down 8%, what do I have to do? Go up, 20% just to get back to even? Something like that? 15%?
8% down means you're going to need to make 11% or so to go back up to get to even. So the neighbor that's at 92,000 is going to have to go from 92 to 100 to get back to even, and then up even 8% more to get back to 108,000, which the dual direction protection allows. And I have never in my 29-year career seen a liquid trust that gives principal protection and positive interest even on a down market.
So let's just throw this out there. So if we just go with the numbers that you just shared with us, and I think I got it right. So 92,000 needs to go up 11% next year to get back to even. Is that right?
Correct.
We've got this particular product that you're talking about, our 92 would actually be 108 this year because of the protection built in.
Correct.
If I take that 108 and that appreciates at the exact same 11%, am I right in saying that's about 129,000 in that same year?
Correct.
So I was at 129,000 versus 100,000.
That's correct. And the beautiful thing is these trusts are liquid, and in some cases they're no fee depending on the state that somebody lives in. So we have been able to save people management fees and give them some downside protection and keep the asset liquid and give them an opportunity for an up return in a down market. And here's the beautiful thing. Right now, at the rates that are issued, until the market goes up more than 21%, the investor gets 100% of the up. At 22%, they stop at 21.
What a shame. Right? If I could say, okay, I'm protected on the downside. Now I want to go one step further because I know we're out of time, but think about this concept. This advice or this program that Todd's just talking about. I just showed you how you could be $30,000 ahead on a $100,000 investment with these hypotheticals. No, we're not guaranteeing anything. We're not saying that the markets are going to do these things. We're just throwing numbers out there for educational purposes. Now, what if this cost you 2% to do it? So what is 2% of 30,000? Is that 600? I think it's $600. So would you give up 600 for 30,000? And I do that all day long, right? I'd leverage my neighbor's house even, right? The concept here is great advice costs nothing, even though you're paying for it. Think about that. If you want to meet Todd Halterman, give me a call at 800-306-1990. They didn't have these products when I was at Merrill Lynch, I can tell you that, or at least I didn't know about them. But give me a call at 800-306-1990,